Understanding Thematic PSU Mutual Funds, a comprehensive guide. Welcome back to StockRhino. India's public sector undertakings, or PSUs, run some of the nation's biggest banks, power companies, oil firms, and infrastructure giants. But did you know you can actually invest in these government-backed giants through Thematic PSU Mutual Funds? In this video, we'll break down what PSU funds are, why they matter, benefits, risks, performance trends, taxation, and who should consider them. What are PSU mutual funds? Thematic PSU mutual funds are equity mutual funds that invest mainly in public sector undertakings. By SEBI rules, such funds must invest at least 80% of their portfolio in PSU companies. PSU banks like SBI, Bank of Baroda, energy firms like ONGC, GAIL, NTPC, Coal India, infrastructure and engineering PSUs like BHEL, Bharat Electronics, oil refiners and marketers like IOC, BPCL, HPCL. In short, these funds give you exposure to India's government-owned giants. Why PSUs matter? They operate in strategic sectors like energy, defense, banking, and infrastructure. They play a crucial role in nation-building projects, power supply, railways, telecom, defense manufacturing. The government often supports PSUs through capital infusion, reforms, and policies. Recent focus on disinvestment and privatization has unlocked value in many PSU stocks. Strong dividend payouts. Many PSUs are known for rewarding shareholders with regular dividends. Benefits of PSU funds. Exposure to large, established companies backed by the Government of India. Benefit from policy reforms, disinvestment plans, and capex push. Many PSUs trade at attractive valuations compared to private peers. High dividend yields, which provide steady income. Long-term demand in sectors like power, defense, oil and gas ensures relevance. Risks and challenges. Government interference. PSUs may prioritize social objectives over profits. Policy risk. Frequent regulatory changes affect performance. Slower growth. Compared to nimble private players, PSUs are often less efficient. Cyclicality. Sectors like energy and commodities are highly cyclical. Concentration risk. Tied to one theme, they may underperform diversified equity funds during certain cycles. Performance profile. PSU funds have seen boom and bust cycles. They tend to outperform sharply during phases of government reforms, divestment announcements, or commodity upcycles. But they underperform during slowdowns, banking crises, or when reforms stall. Who should invest? Investors with a moderate to high risk appetite. Those who already have a diversified portfolio and want thematic exposure. Long-term investors, 5 to 7 years, who believe in India's PSU reform and capex growth story. Dividend-seeking investors who like steady payouts. If you're a beginner, it's better to first build a diversified equity base. Taxation. If held less than 1 year, 20% short-term capital gains tax. If held more than 1 year, 12.5% long-term capital gains tax on gains above 125,000 annually. Smart investing tips. Limit allocation to 5 to 10% of your portfolio. Keep it as a satellite bet. Prefer SIPs over lump sum. PSU stocks are cyclical. SIPs average volatility. Track government policies on disinvestment, privatization, and sector reforms. Combine PSU funds with diversified funds to balance risk. Focus on long-term holding. Avoid chasing short-term rallies. Common investor mistakes. Going all in on PSU funds, too risky and cyclical. Exiting too quickly. PSU themes play out over years, not months. Ignoring governance and efficiency challenges in some PSUs. Key takeaways. PSU funds equals focused exposure to government-owned giants. Benefits: policy support, attractive valuations, high dividends. Risks: government control, cyclical performance, inefficiency. Suitable as a 5 to 10% satellite allocation for long-term investors. SIP plus patience plus diversification equals smart way to invest. Want to learn more? Visit our website